Okay, everyone, 5 stocks at 52-week lows. Let's go look at them individually to understand them and decide what price to buy them at. First one, Budweiser. So, Anheuser Busch. So let's take a look at the company. Today it's down 1%. 52-week high was $76. It was recently as low as $50, just a few pennies below where it is today. This is a $93 billion company, okay? We're going to go skip, dividend. Look at this dividend, guys. So one thing to keep in mind here, this is a 4.7% dividend. Now, if you're new to the channel, I want you to know that dividends aren't always safe. Don't fall into a dividend trap. The key here is to look at how much they're paying in dividends in our software. Our software will tell you right here, and then right above it, it'll show you the 5-year average free cash flow and last year's free cash flow. Both are over $9 billion. Guys, they can easily afford a $2.36 billion dividend. So this is a safe dividend. Now, it doesn't mean they're going to keep it, but as of right now, it is a safe dividend. So let's skip right to the 8 pillars tab. That way we can see all the information on Budweiser. Look at this. Usually this is flipped. Usually we have green check marks here, and these two are red, the valuation metrics. But it's exactly the opposite here. So they're selling at a reasonable valuation, but everything else is going the opposite direction. A lot of debt, increasing shares, decreased cash flow, decreased net income, decreased revenue, and a low return on invested capital. Does that mean you shouldn't buy the company? No. It just means you have to be a little bit more conservative, okay? So I'm going to initially just look at the income statement, see how it's going. Guys, remember, the reason I'm teaching all this is I realized very early on in life that the more I knew and the more I learned, the less I feared. And that was a big basis for this channel. The more I knew, the less I feared. If you understand the numbers of the company, when you see the stock price go up and down, you will not fear it as much. You'll say, this is part of it, if you understand the emotion. So, this is a big drop in revenue, but guess what? Why is that? Probably because of COVID. I have to guess that. Why would there be such a big drop from 2019, 2020, back up to 2021? But look, guys, 10 years ago, they did 40 billion. Last year, they did 54 billion. It's not huge growth over 10 years. It's very small, okay? So let's go to the most popular part of our software, the stock analyzer tool. Remember, every investment is the present value of all future cash flow, and we don't know the future. So our goal is to make assumptions that are conservative about the future, and hopefully the stock price is selling for below that. So I'm doing a 10-year analysis, and I'm going to put 3 estimates. And I'm going to start with revenue growth and go down the line. And I'm going to give the last 1, 5, and 10-year numbers for the first 3. So first off, revenue growth. In the last 10 years, they've done 3.5% a year. The last 5 years, they've lost 0.3. And last year, they jumped 15.8. So I'm going to be conservative. I'm going to go 1, 3, and 5%. Because if inflation's high, driving up prices, that 5% seems reasonable. If inflation turns around, the economy falls a little bit, discretionary spending on alcohol goes down, maybe it's 1%. Profit margin. Profit margin was down a lot in the last year. It's been down over the last 10 years. It just keeps going down. So I'm going to be conservative. I'm going to call it 10, 12, and maybe they get back to their long-term average. Free cash flow margin, again, decreasing. I'm going to go 16, 17.5, and 19. Now for PE, guys, this is not a growing company. Remember, PE should be a factor considered with 2 things. 1, moat. How secure is this business? This is probably a pretty secure business, but 2, growth potential. Remember, if a company is selling for 30 times PE, is that good or bad? Well, we don't know. If I told you the company wasn't going to grow for 10 years, that's bad. But if I told you the company was going to grow 100% a year for 10 years, 30 PE is really cheap. That's the whole point of it. What's the future potential? This potential is low, so I'm going to assign a very low PE, especially considering, if you remember, the debt on that 8 pillars was pretty high. They had 11 times their free cash flow in debt. That's a lot of debt here, 11.5 times. So I want to be conservative there. And for price of free cash flow, I'm going to do the exact same thing because our PE and price of free cash flow should be the same over long periods of time. And finally, desired return, 12.5%. Guys, I've said it 1,000 times. You can get 9 or 10% from investing in the S&P 500 and an ETF. So if you want margin of safety and a reason to buy an individual stock, make it a little bit higher. I go with 12.5% for such a big company. I hit the analyze button. The stock is currently 51.58. Wow, look at this. So low side, 27 to 40. High side, 56 to 77. So if you believe all my high side numbers, then you'd go buy the stock today. In the middle, it's 40 to 57. So it's right in the middle right now. This might be something to look at. What I would do, I'm going to put add it to my watch list. And maybe I want to know when it hits below 50, notify me. And if you have our software and you've been paying attention, follow along for the other 4 companies. But now you can sit there and get notified with your app and email when it hits below 50 or whatever number you put. Fact number 2, Proctor and Gamble. So again, we go back to our main page, hit PG, also up 2.6% today. 52-week high of 165, the low of 132. So it's off its low right now. So guys, another good dividend of 2.7%. Again, like the last company, we look at the dividends paid of 8.7 and the last 5 years and last year's free cash flow. This is a much bigger piece of the cash flow. So it's not as secure as Budweiser's, but they can still afford it. I like to see a number below 50%. So again, guys, if you subscribe to our software in our community, please follow along. It'll help you get even more well-versed in the software, which can be very useful for you. So let's go to the 8 pillars tab. So we click on 8 pillars. So guys, unlike Budweiser, it's exactly the opposite. 2 X's for valuation, everything else is a check mark. Listen, Procter and Gamble is this go-to consumer products kind of company. They have so many, it's not recession. I don't believe anything is really recession-proof, but people are still going to buy the things they need from Procter and Gamble. They might cut back a little bit, but they're still going to buy those products. They're very sticky products. So let's go to the stock analyzer tool and see if 32 PE and 26 price to free cash flow is reasonable. So in the last 10 years, the revenue growth has been negative. Did they sell off divisions? Let's go check why that is. So like I said, the 8 pillars tells us, I go to the cash flow statement. They made acquisition. Oh, interesting. So they still had net acquisitions, but their income is still down. The revenue is still down over the last 10 years. That's interesting. But it dropped a lot from 14 to 15. They must have sold something off. Must have been, they bought something and sold something and the net was still a negative. So that's probably what happened there. Stock analyzer tool. I'm going to go 1, 2.5, and 4% revenue growth. Profit margin, I'm going to stick with the 14, 15, and 16. Free cash flow, 16, 17, and 18. PE. Guys, this is a boring company with very, very low growth prospects. I'm doing 12, 14, and 16. And I'm doing a 12.5% return. I can pretty much assure you right now, it's going to be all red. Hit the analyze button. Boy, look at this. It's got to fall in half. A low of 40s, a high of 70s, middle of high 50s. So I'm going to sit there and set a price target for $70.24, add to my watch list. And the reason being, guys, you got to remember, stocks are reflective, your returns are reflective of future cash flow. If the revenue is not growing substantially, your cash flow will not grow substantially. That's just a fact. It's just math. Stock number 3, American Express. This is a Warren Buffett favorite. So we're going to AXP. Again, let's look at the main metrics. The stock is currently at 144, had a recent low of 137, as you can see right here, and it's bounced back from there. Dividend, very small dividend, 1.4%, eats up only $1.5 billion of their average in the last 5 years of $10 billion, and last year they did $14.5 billion. Now, guys, American Express, you swipe your card. I'm going to be very conservative in the revenue growth because of where we are economically. Could there be a recession? Could there not? So I'm going to go to the 8 pillars first. And I'm just going to look at these 8 pillars overall. And because of the kind of company it is, there's no ROIC data or debt data here because they don't have long-term liabilities. But the PEs and price to free cash flow, there's a big difference. PE showing a lot lower. Sorry, earnings are showing a lot lower than free cash flow, and that's why the ratios are flipped. Okay, so let's just go right to the stock analyzer tool and see what we think. Revenue growth assumptions. Look at this, 31% revenue growth last year. Okay. I'm going to go 2, 4, and 6%. Profit margin, 14, 14.75, and 15.5. I'm just going, like guys, most common question is how do I determine these? Well, I look at things. The longer the average, the more it's weighted to me. And it's decreasing here from the 10 to 5 year. So I'm going to go a little bit lower than these. My goal is to be conservative and buy stock when it's selling for below my conservative estimates. That's the margin of safety we talk about. Free cash flow margin. 24, 25, 26. PE, 13, 15, 17. Guys, with this brand, I'm going to pay 13, 15, 17, maybe even higher. Hit the analyze button after my 12.5% return. The stock is currently 144. Look at this. Quite a bit of green. We have a wide ranges. Why? Look at the big difference between profit margin and free cash flow margin. Big differences. So a low of 90 and a high of 155 for earnings estimates and 157. Based on free cash flow, it's a buy all day today. So you decide what is your, based on these assumptions, what is your requirement? So I'm going to add, it's currently 144. I'm going to add a watch list when it hits below 130. That way I can at least take a look and see if anything's changed for me. Maybe I sell some puts. Next stock, CMCSA, Comcast. So again, Comcast Corp, $38.34. High of $61.79 just back in September, guys. That's fallen almost, no, how much has it fallen now? Not half, at least 35%, okay? Dividend, look at this dividend, guys. 2.8%, that's a healthy dividend. And it only eats up $4.6 billion of their cash flow. And last year they did $16.6 billion, and their average over the last 5 years was $13.55 billion. So good cash flow there that can support that dividend. Let's go to the 8 pillars tab real quick. And let's see where the stock is. Okay, so some downfall. They don't get a high return on invested capital. That means the money that's invested in the business, they don't get a good return on it. That's not a great thing for long term. Put a discount to your earnings on that one. Higher debt. It's a cable company. I think it's pretty standard for cable companies. And a decrease in net income. So I'm immediately going to go, that's a big decrease. Revenue's up $33 billion. Cash flow's up 6.5, but net income's down. This tells me there might be a write-off that happened. So let's go to the income statement. Because remember, guys, the 8 pillars are a story that's being told to you. So look at this. Look at daddy here. Ah, that's what it is. Look at this, guys. One fluke year with a big earnings. Okay, so that's a check mark. I'm not worried about that. This is why we look at the numbers. This is why we learn things. The more you know, the less you fear. You're going to look at that number going, oh my God, their profit's down $9 billion in the last, the more I know, it looks like it's a fluke. $9 billion, $12 billion. Look at all the other years. It was one fluke right here. So guys, you're probably thinking, oh my God, look at all these sheets, intimidating. It's not. It's just a comfort level. I know you might find this funny and not think it's possible. We are the same people. I've just been trained since I was 13 because I happen to be about it. You can learn this. In our community, we've had 12,000 people sign up who all understand these things, but they didn't necessarily do that when they first joined. If you watch more videos, you join our community, you will understand more, trust me. And you will see numbers like this and go, oh, by the way, think of an income statement like your personal income statement. How much did you bring in revenue? What's your pay? How much did you spend? And then what do you left for the end of the day? The net income. All financial statements are basically a bigger version of your own personal life. That's it. That is it. This is not intimidating at all. Watch more videos, get yourself around it. Everything you've done in life was scary when you first started, but the more and more you learned and the more and more active you got with it, the better it was. So let's go to Stock Analyzer tool and see what we should pay for Comcast. Revenue growth. Oh, they probably made a lot of acquisitions along the way. Let's see how many acquisitions they did. So I go to the cash flow statement. On the cash flow statement, there is a line, acquisitions and dispositions. When you see a negative number, it means they bought something because it's money out. When you see a positive number, they net sold something. But look, a $38 billion acquisition right there. So that's probably driving a lot of revenue growth right there. That was 2019. Let's see what their income did from 19 to 20. Had a good sized chunk increase. Stock Analyzer tool. Let's be conservative. Let's call it 2, 4, and 6%. Profit margin. So I'm looking at the last 10 years. I'm going to go 11, 12, and 13%. I'm going to do the same thing for free cash flow. Now, guys, I'm actually going to go lower on my PE. Why is that? The cable business is struggling a little bit. Now, granted, keep in mind, sports are going to be very big for this. Comcast can be very big. Sports are the only area where people watch live all the time. Nobody watches the NBA Finals 3 days later or even a day later. Nobody does that. The internet's too active. You get notifications on your phone. The second the Warriors won a title, it literally said to me 14 seconds later, the Warriors clinched their 4th title in 8 years. There ain't no hiding from that, right? I remember the movie Air Force One, where Harrison Ford was the president, and he was a Michigan man, because I remember this, and he kept telling everybody, don't tell me what happened in the Michigan game today. Don't tell me what happened in the Michigan game today. That would not exist today. That does not work today. And finally, your desired return, 12.5% if you want. You might want to go higher because it's cable. So the stock's currently at $38. All right, look at this, guys. We're 1 penny above the middle number. We have a low of 28, high of 51, and 1 penny above the middle number. Let's hit analyze again and see if it updates. There you go, it's green now. Look at that. So we have 4 green numbers. So for me, I might want to sit there and say, let me pay a little bit of a discount. Notify me when it's $30. Because I'm not really eager to own Comcast. So let's go that way. Final company, Meta, formerly Facebook. Let's look at it. So go to the 8 pillars. Now, guys, one thing I want you guys to know about Meta. Yes, their user growth is stalled and their stock has plummeted. Look at this high, 384, just less than a year ago. Now it's 150, was 157 today. It's down $5 today and the market's up a ton. Look how much the market's up today. 2.6% of the NASDAQ, and Meta is down 3% today. That is huge. So what does that mean? My belief about Meta is they haven't maximized their revenue per user, and they have not, even though their user growth is stalling, they have 3.5 billion people, and they're getting into the metaverse, and they're going to be the leaders of the metaverse by changing the name, everything. Now, does that mean it's going to work? I don't know. But I still believe that even if the metaverse doesn't work, they still have not maximized the revenue per user on Instagram, Facebook, WhatsApp, and the 3.5 billion people who use them every day. So let's go to the 8 pillars and check it out. 8 pillar thriller. Timo, do you see this, baby? 8 pillar thriller. All of its check marks. No dividend. Look at this cash flow. 24 billion the last 5 years average. Last year they did almost $40 billion, and the stock is down a ton. Let's go right to the stock analyzer tool. So I'm going to be really conservative on revenue growth, guys. Watch this. 6, 9, and 12% revenue growth. Profit margin, I'm going to go 28, 30, and 32. Free cash flow margin, 30, 31, 32. Actually, I'm going to go 29, 31, and 33. PE, 12, 14, 16. 12, 14, 16, and a 12.5% return. Guys, I think this PE is actually low, but I'm still going to be conservative on it. I'm at the analyze button. It's all green. So you decide what you want to do here. If you believe all these numbers, go do more research. All these companies, if you agree with my numbers, go do the research. If you don't agree with my numbers, go do the research. What's the next step? Join our community, have conversations about every single one of these stocks. Go read the 10K. It's a lot more fun than you think. It can be a lot of excitement. Have 12,000 people help you with your research. It's a great way to do it. Remember, guys, the more you know, the less you fear. If you want to learn more about the stock analyzer tool, because it's very intriguing and the best software we have in our software, click this next video. We explain it very thoroughly.